There's a tension that lives inside almost every successful incorporated business in Canada. You're doing the right thing, you're growing the business, you're keeping the retained earnings inside the corporation, and then you're investing that money so that you can compound your wealth over time. And every single year, a big chunk of that wealth is being siphoned off in two ways that most people really haven't fully understood. So you've got the passive income tax, which is the tax on your investments that approaches 50%. And then you've got the passive income grind, which is the AAII, the Adjusted Aggregate Investment Income Rules, which takes away your small business deduction at the same time that your other investments are growing. So there is a structural fix to this that most accountants don't really bring up. And it's not because they don't know about it, but it's because it's not really their job to introduce it. Hi, my name is Laurent Munier, and I'm a partner and advisor here at Safe Pacific Financial. And in today's video, I'm going to walk you through a tool that solves a very specific corporate balance sheet problem. And I want to do it in a way that more people should have it explained to them, not as an insurance pitch, but as a really structural conversation. Why does participating whole life behave like a corporate asset? So I'm going to start by reframing something. When most business owners think about life insurance, they think about it as a cost. This is something that you pay for, a monthly drag on the income statement in exchange for the protection that you need from the insurance if something bad happens. And that's accurate for term insurance. Term insurance is generally an expense. You pay the premiums, you get the coverage, the policy is in force, you get paid if something happens, the policy expires, and that's the end of it. On the other side, we have what's called participating whole life insurance, and this is a completely different animal. And I would argue that the word insurance is actually just a small part of how it works and the benefits that you get from it. Because what happens when you have a corporate-owned participating whole life policy is when you strip away the label and you just look at the mechanics of how does this thing work, you get a tax-sheltered fixed income allocation on the corporate balance sheet. And now I'm going to walk you through what does that mean in just proper English. So inside one of these properly structured par policies, your premium dollars go into two places, right? Part of it pays for the actual insurance coverage, which most people understand. If something happens to you, the insurance pays out. A bigger part of that, when you structure it properly the way that we do with our clients, goes to cash accumulation. It goes to build up what's called a cash surrender value. And that cash value is invested by the insurance company in a large, professionally managed pool of assets called the participating fund, which is why these things are called whole life participating policies. For most Canadian insurance companies that offer this pool is heavily weighted to the kinds of assets that you would expect to see inside a conservative institutional portfolio. So you've got investment grade bonds, you've got commercial mortgages, real estate, infrastructure. Some of them have equity exposure. And so it's that kind of like diversified, it's oriented around stability. It's like a pension fund or like a large endowment, what they would build, right? And the returns on this pool, this participating fund, obviously minus the costs, are credited back to the policyholders in the form of dividends. And these dividends, the way we set it up, are used to purchase additional paid-up insurance, which adds to your life insurance, which adds to your cash, which increases your death benefit, which adds to your cash. And this additional insurance also generates the next dividend, and then it just compounds and just keeps repeating. So the key part here, especially for our purposes today, is the growth inside the policy, the cash value growth, the cash value accumulation, the dividend being reinvested, the compounding. This all happens without any tax triggering inside your corporation every year, like it would in a traditional investment. So if you compare that to a corporate investment account, if you had $100,000 in dividend paying stocks or even just GICs earning interest or bonds, every dollar of that investment gets taxed at corporate rates every year. And this is the tax drag. This is how you don't get ahead. Inside these participating whole life policies, that tax drag doesn't apply in the same way. The growth happens inside the policy on a tax-deferred basis every single year. So the first way to rethink about this is, stop thinking about participating whole life insurance as insurance with some bonus features, and you could start thinking about it as a corporate asset that also includes insurance protection as one of the features, and you probably need the insurance. So the asset is the cash value. The asset is this long-term compounding. The asset is the tax-deferred growth inside your corporation. The death benefit is obviously very real and very important, and we're going to talk about it more in a couple minutes when we start talking about what's called the capital dividend account. But the strategic value and the reason that this tool exists in sophisticated corporate plans is the asset behavior. It's not just the death benefit. And so this is why I want you to rethink about this as we go through this conversation. So what are the three things, the three mechanics that make this thing work? I've been describing this kind of like conceptually. So now we'll get a little bit more specific about these three things that make this strategy actually work and work for incorporated business owners. The rethink is one thing, and the mechanics is what really determines whether this is generally useful for your specific situation or not. So the first one is you can fund these things more through what's called EDO, that's used to buy a paid-up additions rider. So the participating whole life policy has a base premium. So this is the minimum that you need to pay to keep the policy in force. But when you're using these policies as an accumulation tool rather than just the pure insurance, there is this thing called EDO, the accelerator deposit option. Or for some insurance companies, it's called ADO, the additional deposit option. They're the same thing, just different brand names. And this is the additional cash above the minimum premium that you're allowed to pay into the policy. And this is what supercharges the cash value growth. The EDO funds, the way that we set it up, are used to buy what's called paid-up additions, which we talked about. And usually this is PUA. You'll see this online. And so this changes the entire economics of how the policy works. These paid-up additions go directly into purchasing additional paid-up permanent life insurance, which then accelerates your cash value accumulation in those early years. And this is the difference between when you see a policy that takes 10 or 12 or 15 years to break even on the cash value, and a policy like we would design that usually you could break even on year 3 or 4 or 5, right? It makes a significant difference in how the cash builds up. And then the way that these policies are typically structured for accumulation is really heavily weighted towards these additional premiums, the EDO and buying the paid up additions. And sometimes we can have, 80 or 90% of your total annual contribution be EDO rather than just going to the base premium. And so what do you get as a result? The policy is much more like a savings vehicle that has insurance attached rather than an insurance vehicle that has a savings attached. So it's not a small distinction, right? It's the entire reason that this works as a corporate asset strategy. If your accountant has ever looked at a regular participating whole life policy and said the cash value takes too long to build up, they were probably looking at one that had the base premium heavily funded and not a lot of extra cash going to the EDO. A properly designed policy for accumulation, the way that we do it, fundamentally looks different. The numbers are just totally different. The second one is the AAII. This is a great tax name. It's the Adjusted Aggregate Investment Income. And this is the part that most people haven't heard. So you may remember earlier in the video, I talked about the passive income rule. So once your corporation, if you've got the investments inside your holding company, inside the corporation, once that generates more than $50,000 in passive investment income in a year, then you start losing access to your small business deduction at a 5-to-1 ratio. So by the time you're earning $150,000 in passive income inside your holding company, you lose your entire small business rate totally on your active business income in the operating company. So this could mean an additional 15% or more in taxes on your operating company, depending on the province that you're in. So here's the thing that people don't really talk about clearly is that the growth inside these participating whole life policies don't count towards your aggregate adjusted investment income or your passive income, right? Especially for the purposes of the small business deduction grind. So this is the most important part, is as you grow this cash inside the holding company, this does not affect your passive income rules or your AAII. And the cash value could be growing at 4%, 5%, 6%, whatever it is, whatever the dividend scale is. And it compounds inside the policy year after year with no tax. And none of that growth contributes to the passive income that's taking away your operating company's tax efficiency, right? If you're subject to the small business deduction. So this is a huge structural advantage and basically can save you like double in tax. So if you have a corporate investment portfolio and it's getting you towards that 50,000 threshold or getting you towards the 150,000 threshold where you would lose your small business deduction, you kind of have two options, right? You can just take it, you accept the grind on the small business deduction, or simple thing to do is you could redirect a portion of your retained earnings into something that generates a similar long-term growth without contributing to the passive income calculation, right? So this participating whole life policies, it's one of the things that we can do that. And it's why we're using it so consistently in financial plans for business owners, right? Or for incorporated professionals who have retained earnings inside their company, inside their holding company usually. Now, it's not a loophole. It's not a gray area. There's no tricks here. These are standard CRA and insurance company rules. This is how this insurance works, right? The insurance growth is treated different from investment income for these passive income or AAII purposes. If your accountant hasn't walked you through this distinction explicitly, it's not their fault. It's not because they don't know. It's because applying it to your situation requires a different type of strategy conversation that is usually outside the scope of what an accountant is supposed to do. They're not doing a bad job by not telling you about this. It's just not their job. The third thing that we want to talk about, the third mechanic, is the capital dividend account, their CDA. And this is at the very end. When this insured person eventually passes away, the death benefit pays to the corporation that owns the policy, and it pays totally tax-free to that corporation. And so now the corporation has this tax-free money. And so what do we do? How does this work strategically, and what happens next, right? The death benefit minus the policy's adjusted cost base generates a credit to what's called your CDA, your capital dividend account. And then the money in the CDA can flow out or be distributed to shareholders as a tax-free capital dividend, not tax-deferred, tax-free. So the corporate capital that's been compounding inside the policy for 15, 20, 30, 40 years, eventually it exits the corporation through the CDA and can flow out to your shareholders, your beneficiary shareholders, with zero tax. So now if you compare this to the alternative, you've got your retained earnings that are in some sort of corporate investment. So you're either invested in the market or in real estate or bonds or GICs or whatever you are. Those get taxed annually. They also increase your passive income. And then once your passive income hits that 50,000 threshold, it starts to grind your small business deduction on your operating company, which effectively doubles your corporate rate once you get that grind down to zero. So you're paying tax all the way along the way. And then when you eventually pass away, that investment portfolio is going to pass not tax-free. It's going to eventually hopefully end up to your beneficiaries, but it's going to go through all these different layers of tax before it gets to them. So you're going to be giving whoever, your kids, most people, significantly less. Inside the participating policy strategy, it's a fundamentally different path, right? The whole growth inside all the way is tax-free or is tax-deferred, but since you don't ever take it out, that never happens, so that essentially tax-free. And then when it pays out to the corporation and then to the beneficiary shareholders, totally tax-free, whatever amount is above the adjusted cost base. So now when you put these things side by side and you map these three mechanics together, you have the accelerated cash value growth through your EDO. You have the passive income rules exemption, your AAII exemption, and then you have the money going out through the CDA. What you're looking at is this corporate balance sheet tool that addresses three of the biggest tax pain points that an incorporated person faces. If your cash value isn't growing fast enough, problem is solved by additional EDO deposits according to your contract. Your passive income is grinding away your small business deduction in your operating company, doesn't apply here. Double taxation once the money or once you pass away and this money has to pay out to whoever, your shareholder beneficiaries, you don't need to do that when you have it through a whole life participating policy because it can go through the CDA. You got to stop thinking about it as insurance with some tax feature. This is like a corporate financial structure that has insurance attached. And this is kind of like the mindset shift, right? Now let's do a simple side by side. And I want to make this with some concrete numbers, but still very easy. And I'll be really transparent about the assumptions because the math really depends totally on the assumptions, and I want you to see what the inputs come from. So we'll compare two scenarios for the same incorporated business owners. In both of the scenarios, the owner is contributed $100,000 per year of retained earnings into whatever they're using to build their long-term wealth. And then they're going to do this for 20 years. This owner lives in British Columbia, so the top corporate tax bracket for passive income. So let's talk about scenario A. Just invests corporately, right? The 100,000 goes into a diversified corporate investment portfolio, and we can assume an average like 6% growth, nothing crazy. And this is the income mix that you would get from like a balanced portfolio. So you're getting some interest, some dividends, some capital gains. Then after you account for the corporate passive income tax rates that apply to each type of the income, that net effective tax drag on the portfolio is somewhere in the range of 25 to 30% per year. And this is optimistic, right? For a more interest-heavy portfolio, like you have more bonds or GICs, this would be higher. So now over the next 20 years, with the annual tax drag just eating up the compounding, that corporate investment account ends up roughly around $2.5 million on the balance sheet. That's a real number, successful outcome, good job. But before you can spend any of that money personally, like before you can take someone out for dinner, you need to get that money out of the corporation and you need to get it into your own pocket. So you're going to pay yourself dividend or salary. So these dividends paid to the shareholders, to you, will be taxed personally at the rates today, roughly ranging in the 25% for eligible dividends if you're in the lower bracket, or over 40% if you have non-eligible dividends and you're in a top bracket. After the dividend extraction tax or dividend income tax, the net spendable that's in your pocket is approximately about $1.5 million. So scenario A, after you pay the money out to yourself, you've got about $1.5 million in your pocket to spend. Scenario B, let's run this instead through a corporate-owned participating whole life policy. Same inputs, same $100,000 a year, same you're doing this for 20 years, and we're building it the way that we would build it, which is got the maximum EDO, and the EDO is buying the paid up additions. So the cash value inside the policy is growing on a tax deferred basis. And based on today's current dividend scales, right? And so these dividend scales are not guaranteed, and they will change next year and the following year and the following year. But today, for the numbers, we're just going to use today's numbers. So at around 6% is kind of what the insurance companies, like most of the insurance companies, are around that right now. So the cash value in the 20-year mark would probably be around $2.7 to $3 million, depending on the company that you run the numbers with. Then you have the life insurance death benefit at that same point, which will be significantly higher, often probably like $4 to $6 million, again, depending on the company, depending on how old you were when you started it and how you structured it and everything like that. Now, here's where the advantage is. If the insured person passes away at any point, even on the day after they start the policy, the entire death benefit pays out to the corporation tax-free, and most of it will go through the capital dividend account to the shareholders tax-free. So if we're comparing what eventually reaches the shareholders' family in the estate, we're comparing, $1.5 million from the first scenario to $4 to $6 million in the second scenario. And that's like an immediate significant difference, right? Let's set aside the death benefit and we'll look at just the cash part of it. And this is where you want to access the policy's cash values while you're still alive. You want to use the money for stuff. And that cash value, typically the way you're going to use it is you're going to borrow against it on a tax efficient basis through either a policy loan from the insurance company or a collateral loan, some sort of lending agreement with a bank. And this means that the corporation can access capital from the policy without triggering any sort of taxable events while your cash value is still continuing to grow. The comparison isn't really like cash account versus policy. It's taxable corporate investment account that produces a fully taxed outcome when you need to take the money out versus a tax-sheltered corporate asset that produces either a tax-free distribution at death or a mostly tax-free distribution at death without disturbing the underlying compounding of the policy, right? All unicorns and daisies so far, but let's have some honest caveats. The past dividend scale from the insurance companies are not a guarantee of future performance, right? I can't guarantee you what the dividend is going to be in the future. But insurance company participating accounts, the ones that we deal with, have paid a dividend every single year for 100 years and never not paid a dividend. So I can't guarantee you they're going to pay you one in the future, but they have paid one every single year for the last 100 years. And the policy design is built around having a dividend. So you could sort of expect there to be one, but it's not guaranteed. And then the numbers that I showed assume that the policy is structured the way that we do it, which is very different than the way that most people would structure a whole life policy. So we will do it for the maximum cash value, putting the maximum amount of cash inside the policy. If you have a poorly designed policy or one that's not designed for maximum cash accumulation, the scenarios that I just kind of outlined, the mechanics work, but the numbers will be significantly different. And then the math on all of this depends on the policy being held for the very long term. These are not strategies that produce results in a year or 2 years or 3 years. The compounding effect requires time. So if, understanding these constraints, the after-tax efficiency gap between the corporate investment account and a properly structured participating whole life account is significant. Often, for clients could be hundreds of thousands of dollars over a 20-year period. It could even be millions. The gap is the answer to the question that your accountant probably hasn't fully articulated to you yet. And now I also want to say, who is this genuinely for and who is this genuinely not for? It's definitely not for everyone. And pretending otherwise is pretty dishonest and can cause big problems. So how do you know if this is for you? Number one is you have retained earnings inside your corporation that are not required for operations. Typically talking about owners that have a few $100,000 or a few $1 million inside the corporation, and they're adding retained earnings every year. Their business is profitable, and then they want to invest that money for the long term rather than spending it through the business. And I would say, talking about long-term horizon, 10 years at least. 20, 25, 30, 40 years is better, right? There's a reason these policies are called whole life policies. They are meant to be set up for your whole life, your entire life. So this is not a good strategy if you're planning on setting up one of these policies and canceling it in the next few years. You shouldn't do it. If you are going to need the liquidity, you're going to need that money right away. It can be arranged through the collateral lending that I talked about, but if you're going to need to cash these things out, just don't do it in the first place. Secondly, you should have a stable cash flow that is sustaining this consistent funding over time, even if you have a difficult business year, right? The strategy's efficiency assumes that the contributions are continuing uninterrupted. So you do need to be making these premium deposits every year. If you have a year where you can't fund the policy as designed, obviously there's workarounds, but really you should be funding these policies consistently for years. At least 10 years is kind of our baseline when working with clients. And that's how you know that this could be a good idea for you. Also, you're already running into the passive income problem. You're getting towards that 50,000 or even up to the 150,000 passive income, or you see that this is going to be happening to you in the next couple of years, right? And you want to continue to accumulate money. So the tax friction is real and it's ongoing for anyone who's in that passive income zone, that AAII kind of rules threshold. You also want to be thinking about wealth in the long term, not next quarter, not next year. This is a balance sheet strategy that has a big estate payout at the end. This is not something that's designed to produce results that are going to show up on, this year's tax return. Now, who is this not for? This is really important. Just as important as who this is for, it's probably even more important who is this not for. If you need all of the money that's in your company and you need it all the time, this is probably not a good idea. The cash value that's inside the policy is accessible through the policy loans or through collateral lending, but it's not the same as having that money sitting in a checking account where you can just get it. If you're likely to need really fast, no friction access to the money and you need it right now, this is not what you want to be doing. This is not where you want to put the money. If you can't reliably sustain the funding for the next 10 years, regardless of what happens in business, good years, bad years, whatever, if you underfund it for a few years, sure, it's okay. We can work with that, but definitely loses the compounding and it loses a lot of the efficiency, because the whole point of doing these things is to put the maximum amount of cash in. Generally, you want to have consistent, stable adding to profit every year, and then using that profit or that retained earnings to fund these policies. And you can do it, no worries. Another where it might be not in your best interest is if you're very early in the business and you haven't built up the retained earnings yet, right? So this strategy makes sense once there's actual corporate capital to deploy. But before that, the priority probably is you should build your business and you should become more profitable and you should generate retained earnings. That's probably a better use of your time and money. Another one too is if you're very close to approaching retirement and you're looking for some sort of short-term retirement solution or some sort of short-term tax solution. This is a long horizon strategy. If you're, a couple years away from selling the business and stopping work, this is maybe not the right tool for you, because you do need to be funding it for a significant period of time. Unless you're coming to it with like a big chunk up front that we can space out over a couple of years, like 2, 3, 4, 5 years, but then your initial deposit needs to be significantly higher, right? Like I'm probably like in the millions. And I'm being very deliberate about this. And I really want to say like, this is for these people and it's not for these people, because just as a broader point on the industry, sometimes the financial services industry tends to oversell things, especially tools, right? Like, so this is a tool and they oversell it as universally appropriate. Everyone should do it. Best thing since sliced bread. This is not that. Right? This strategy works really beautiful for certain clients, and it can be completely wrong and a total disaster for different clients who have a different financial profile or different goals or different life setup. So the answer to the question, right, is this the right strategy for me, is, sometimes yes, sometimes no. And figuring out, is it a yes or a no for you, requires looking at your actual specific situation. And then that's where we would work with you or your financial advisor should work with you to figure that out. Now, if you are an incorporated business owner and you do fit this profile that I just described, then this strategy could produce, meaningful, durable advantages over time. If you don't fit this profile today, you may fit this profile soon. So we actually do work with a lot of people who, they reach out to us now. We work with them and say, maybe you're not ready, but when these trigger events happen, that's how you know you're going to do it. And then they come back 1 or 2 or 3, 4 years later and say, okay, well, now I'm ready to do that, right? And then if you really just don't fit the profile, if you're one of those ones that I said, don't do it if you do this, then don't do it. Because we've also got people who kind of see strategies online and they really want to do it, but their situation says you shouldn't. And then they go and they search different advisors until they find someone who tells them yes. I mean, like, it's your life. You can do whatever you want, but we're not the ones that are going to do that for you. What your accountant is and isn't doing in relation to this. So I want to address the title of the video directly, because, the corporate asset that your accountant isn't talking about. This isn't critiquing accountants. We love accountants. We work with them all the time. Your accountant is doing probably exactly what they're supposed to do, what they're trained for, what they're compensated for. They're managing your corporate compliance, your taxes, they're filing your returns, they're advising you within their scope. What they're typically not doing, because it is outside of their standard scope of an accounting engagement, is they're not proactively designing a long-term life insurance-based corporate balance sheet strategy for you. It's not their job. That's not what they charge you for. And in most accounting practice, they don't have the bandwidth to also advise on life insurance to hundreds of clients, right? This is our job. They do their job. If you don't hear about this strategy from your accountant, it's not because they think it's a bad idea. It's usually because this conversation hasn't been initiated, and their service model and their compensation model, this is not part of it, right? So this isn't really their job. When the conversation does get raised and a properly designed, policy gets brought to your accountant by someone like us, the response from competent accountants is usually, hey, that makes sense. Let's coordinate and see what next steps are, right? And the strategy works because your accountant, your financial advisor, the insurance specialist are all aligned on what is being done and why it's being done. So what I'm describing in today's video is not an alternative to your accountant. It's a complement to the work that they're already doing. And it's applied to a very specific corporate structural problem that typically they don't address proactively, right? So the coordination of all of that between all the different advisors is the point. So let's close this out and we'll bring it all together here because we're getting long. If you are an incorporated business owner and you have retained earnings that are growing inside your corporation, you're going to come up against this passive income math that is going to start to hurt. But there is a tool that exists specifically to address this problem. And it's a very old, very vanilla, very boring tool. It's a tax-sheltered allocation on your corporate balance sheet. The growth doesn't trigger the passive income taxes along the way. It doesn't count to your AAII calculation that erodes the small business deduction. And eventually, when you're no longer here, that money can flow through the capital dividend account to your shareholder beneficiaries in a totally tax-free way. So it's not insurance in the way that most people would think about insurance. It's a corporate financial structure that has insurance characteristics that's really designed for owners that have retained earnings problems. They also have a long time horizon. They want to build wealth and compound efficiently inside the corporation. So it is a really specific profile of person, right? So if your situation matches this profile and you feel like there's probably a better way to grow your corporate money, to use your corporate money and then eventually pass it on to whoever, probably your kids, then this is a conversation that we should have. We work with incorporated owners, we work with incorporated professionals all across Canada to design and implement this kind of strategy. And we coordinate with your other advisors, your accountant, your lawyer, investment advisor. And the first step is really to just run the numbers on your situation. We can look at how your corporate capital is deployed, what the passive income exposure looks like, and whether this could actually improve your position or not, right? How do we know? Well, number one is you book a discovery consultation with us. So you go to our website, safepacific.com. There's lots of buttons there where you can book straight into our calendar, or you can send us a message and somebody will reply within 24 hours so we can book a time. And then we're going to go through all your numbers. We want to walk through your numbers. We want to explain what we see. We'll tell you honestly whether this strategy fits your situation or not. If it does, we can show you how it would be structured. We can show you what numbers look like. If it doesn't, we'll tell you no pressure, no rush. We just want to have a real conversation about your current situation, about your goals and your concerns moving forward, and whether or not we would be a good fit to help you, reach your goals and avoid your concerns. So go to the website, safepacific.com, click on one of the buttons there to either book a meeting straight in our calendar or send us a message. And I'm going to wrap it up right now. That's it for me. My name is Laurent Munier, and I'm a partner and advisor here at Safe Pacific. I want to say thanks so much for watching, and I will see you on the next one.